What if I told you that every dollar in your wallet, every number in your bank account, every cent of your paycheck doesn't actually exist? Not in the way you think. Here's the thing they don't teach you in school. America doesn't run on productivity. It doesn't run on gold. It doesn't even run on tax revenue. America runs on debt. Debt that's created out of literally nothing, multiplied through a system so twisted that when you finally understand it, you'll never look at money the same way again. You feel it, don't you? The rent that keeps climbing. The groceries that cost twice what they did 3 years ago. The job that pays the same while everything else explodes. You've been told it's inflation. You've been told it's supply chains. But what if the real answer is something they've been hiding in plain sight for over a century? I'm about to show you the receipt. And before we go further, drop a comment below and tell me where you're watching from. This community is built on people like you who refuse to accept the official story. If you're here for the unfiltered truth about how money actually works, hit that subscribe button right now. Because what I'm about to reveal will fundamentally change how you see the entire economy. The system isn't broken. It was designed this way. And once you see the machine, you can't unsee it. Let's start with a moment in history that sounds like ancient economics, but is actually the blueprint for your financial slavery today. December 23rd, 1913. Most Americans were preparing for Christmas. Congress was mostly gone for the holidays. And in a nearly empty chamber, a small group of representatives passed the Federal Reserve Act, legislation that would fundamentally restructure how money works in America. The official story? This was a brilliant reform to prevent banking panics and stabilize the economy after the disaster of 1907. A group of concerned statesmen creating a central bank to manage the money supply responsibly. The reality? A private consortium of the largest banks in America, J.P. Morgan, the Rockefellers, the Rothschilds' American agents, engineered a system where they could legally create money, loan it to the government at interest, and make the taxpayer guarantee the whole scheme. Sound familiar? Because here's what actually happened. Before 1913, banks could only loan out money they actually had. If you deposited $100, the bank could lend maybe $90, keeping $10 in reserve. Simple, limited. The money supply was tied to something real, gold, silver, actual reserves. But after 1913, everything changed. The Federal Reserve was given the power to create Federal Reserve notes, what we call dollars today, literally out of nothing. No gold needed, no reserves required, just creation. And commercial banks were given a new superpower, fractional reserve lending on steroids. Here's how it works, and pay attention because this is where your paycheck disappears. You deposit $1,000 in your bank. The bank is required to keep only 10% in reserve, so $100. But here's the trick. They can now loan out $900 to someone else. That person deposits the $900 in their bank. That bank keeps $90 in reserve and loans out $810. That person deposits the $810, and on and on. From your original $1,000 deposit, the banking system just created $10,000 in total money through this multiplier effect. Money that didn't exist before. Money conjured through accounting entries. Sound familiar? Every time you take out a mortgage, a car loan, a student loan, you're not borrowing money that existed. You're creating new money through debt. The bank doesn't loan you someone else's savings. They literally type numbers into a computer, and boom, money exists. Your debt becomes their asset. Your obligation to pay becomes their profit stream. Now here's where it gets darker. The Federal Reserve takes this scheme to the national level. When the U.S. government needs money for wars, for programs, for bailouts, they don't just tax you directly. They issue treasury bonds. These bonds are promises to pay back money plus interest. But here's the scam. The Federal Reserve buys these bonds by creating new money out of nothing. They call it open market operations. It sounds official. It sounds like economics. But what it actually means is this. The Fed creates money, loans it to the government, and the government promises to pay it back with your tax dollars plus interest. Sound familiar? You're not being taxed to fund the government. You're being taxed to pay interest on money that never existed in the first place. Money created by a private banking cartel with a federal-sounding name, and it gets worse. In 2008, when the banks made reckless bets and nearly destroyed the global economy, who bailed them out? The Federal Reserve. How? By creating $4.5 trillion out of nothing through quantitative easing. They bought toxic assets, garbage mortgages that were worthless, and paid for them with freshly printed money. Your savings lost value. Your purchasing power evaporated. But the banks? They got rescued with money created from nothing, backed by your future labor. 2020? Same playbook. The Fed created $5 trillion in 18 months. Trillions in COVID stimulus, corporate bailouts, asset purchases, all created digitally, all backed by nothing, all devaluing every dollar you've worked for. The pattern repeats. Crisis, creation, inflation. Your wealth evaporates while the system that caused the crisis gets richer. But here's what they don't want you to understand. And this is the piece that changes everything. This isn't a bug, this is the feature. The system was designed to require perpetual debt expansion. Without new loans, new bonds, new debt constantly being created, the money supply contracts. And when the money supply contracts, the entire economy seizes. You think you're working for money, but money is debt. And debt requires someone to always owe someone else, forever, with interest compounding infinitely. Now you might be thinking, okay, but there are rules, right? Regulations? Someone watching to make sure this doesn't spiral out of control? That's what they want you to believe. Let me introduce you to the primary dealer system, the mechanism that connects the Federal Reserve directly to Wall Street in a closed loop that most Americans don't even know exists. Primary dealers are 24 elite financial institutions. Banks like Goldman Sachs, JP Morgan Chase, Bank of America, that have an exclusive contract with the Federal Reserve. They're the only entities allowed to buy treasury bonds directly from the government at auction. Here's how the con works. Step 1, the U.S. Treasury auctions. Bonds to fund government operations. Step 2, primary dealers buy those bonds using money they borrow from the Federal Reserve at near zero interest rates. Step 3, the Federal Reserve then buys those same bonds back from the primary dealers at a higher price through open market operations. Read that again. The government issues debt. Wall Street banks buy it with borrowed money. The Fed buys it back from them at a profit. The banks make money on the spread. The Fed creates money from nothing. And you, the taxpayer, are on the hook for all of it. It's a circular scheme where the government, the central bank, and the biggest Wall Street firms are all at the same table, passing the debt around, creating money from nothing, and extracting wealth from the productive economy. From you. The banks take zero risk. They're guaranteed buyers. They're guaranteed sellers. They profit coming and going. And here's the kicker. This system is defended as necessary for market liquidity. They frame it as stability, as sophistication, as modern monetary policy. But what it actually is, a cartel, a closed loop, a machine designed to extract wealth from labor and funnel it to finance. Now, you're probably wondering, who designed this? Who set up the primary dealer system? Who architected the playbook that lets Wall Street profit off government debt with zero risk while you pay the bill? You won't believe the name. And the receipt is wilder than you think. Let's pull back the curtain completely. The primary dealer system was formalized in the 1960s, but its roots go back to the founding of the Federal Reserve itself. And the architect of the modern framework? Paul Volcker, the same guy who later became Fed chairman and is celebrated as the man who tamed inflation in the 1980s. The irony is suffocating. But here's what you need to understand about the mechanics, because once you see how the machine actually operates, you'll realize why your economic reality feels rigged. Mechanism 1. The money multiplier on steroids. Commercial banks in America operate on a fractional reserve system. As of 2020, the reserve requirement was dropped to zero. Read that again. Zero. Banks are no longer required to hold any reserves against deposits. That means when you deposit $10,000, the bank can theoretically create infinite loans against it. They're only limited by capital requirements, a different measure that's far more flexible and easily gamed through accounting tricks. Here are the numbers. In 1960, the total U.S. money supply, M2, was $300 billion. Today, over $21 trillion. That's a 7,000% increase. But the population only doubled. GDP only grew by about 20x in real terms. Where did that extra money come from? Debt creation, loans, mortgages, credit cards. Every new liability became an asset for the bank. Every promise to pay became money in the system. And here's the parasitic part. Every dollar created this way comes with interest attached. If the total money supply is $21 trillion, but all of it was loaned into existence at, say, 5% average interest, that means the economy collectively owes $22 trillion. There's literally not enough money in existence to pay back all the debt plus interest. The system mathematically requires either perpetual growth or default. Mechanism? 2. Quantitative easing. The money printer goes bar. When the 2008 financial crisis hit, the Federal Reserve deployed a weapon that wasn't supposed to exist in peacetime. Quantitative easing, QE. Here's how it works in plain English. The Fed creates money digitally, literally types numbers into existence. They use this new money to buy assets from banks, primarily mortgage-backed securities and treasury bonds. From 2008 to 2014, the Fed purchased $4.5 trillion in assets through QE1, QE2, and QE3. They called it unconventional monetary policy. What it actually was? The largest wealth transfer from the middle class to the financial elite in human history. When the Fed buys bonds, bond prices go up. When bond prices go up, interest rates go down. When interest rates go down, asset prices explode. Stocks, real estate, everything rich people own. Meanwhile, the new money floods the system, devaluing the currency. Inflation hits food, rent, healthcare, everything working people spend money on. The result? The S&P 500 tripled from 2009 to 2021. Billionaire wealth doubled, but real wages for average workers stayed flat. The Fed created $4.5 trillion out of nothing and handed it to the financial class while telling you there's no money for healthcare, education, or infrastructure. Mechanism. 3. Repo markets, the shadow banking liquidity crisis. Now let's talk about the mechanism that almost broke everything in 2019, a crisis you probably never even heard about. The repo market is where banks and financial institutions borrow money overnight to meet their reserve requirements. It's supposed to be boring, stable, automatic. In September 2019, the repo market suddenly seized. Interest rates spiked from 2% to 10% overnight. Banks couldn't borrow. The entire financial system was hours away from a liquidity crisis worse than 2008. Why? Because the big banks had leveraged themselves so heavily through derivatives and speculative bets that they didn't have enough cash reserves to meet their obligations. The Federal Reserve's response? They injected $400 billion in emergency overnight loans. Then, when COVID hit 6 months later, they went full throttle. $5 trillion in 18 months. $5 trillion. Created from nothing, backed by nothing, distributed to prop up a system built entirely on illusion. Here's the number that should terrify you. As of 2024, the Federal Reserve's balance sheet stands at $7.7 trillion. In the year 2000, it was $600 billion. They've created more money in the last 15 years than in the previous 87 years of the Fed's existence combined. Mechanism 4, the debt spiral endgame. Now let's connect all the dots to the final, terrifying truth. The U.S. national debt is currently $36 trillion. That's 36,000, 1,000. The interest payments alone are over $1 trillion per year, more than the entire defense budget. But here's the trap. That debt can never be paid off, not because of lack of will, because of math. Remember, all money is loaned into existence. If the government paid off the entire national debt, they'd have to take $36 trillion out of circulation. But that is the money supply. If you remove all the debt, you remove all the money. The economy would collapse instantly. No dollars in circulation, no lending, no business activity, total implosion. So instead, the debt must grow forever. Every year, the government must issue more bonds. Every year, the Fed must create more money to buy them. Every year, the money supply expands. Every year, your savings lose value. Every year, you work harder to afford the same standard of living. This is the engineered collapse in slow motion. The system doesn't fail catastrophically. It decays gradually, extracting wealth from labor and concentrating it in assets owned by the financial class. The moral hazard problem. Too big to fail, too connected to prosecute. Here's the final mechanism that locks it all in place. Moral hazard on a systemic scale. In 2008, the banks made reckless, fraudulent bets on subprime mortgages. They knew the loans were garbage. They packaged them as AAA-rated securities. They sold them to pension funds, municipalities, investors worldwide. When the house of cards collapsed, what happened? The bankers went to jail. The executives faced consequences? No. They got $700 billion in TARP bailouts. They got $4.5 trillion in quantitative easing. They got bonuses. 0 executives from major banks went to prison. The firms paid fines that were a fraction of their profits. And 5 years later, the same banks were bigger and more powerful than before. The message was clear. If you're big enough, you cannot fail. If you're connected enough, you cannot be prosecuted. The risk is socialized. The profit is privatized. In the next crisis, it's already brewing. Total global debt is over $300 trillion. Derivatives exposure, financial bets on top of bets on top of bets, is estimated at over $1 quadrillion. That's $1,000 trillion. The entire global GDP is only $100 trillion. The system is leveraged 10 to 1 against reality itself. When the next crash comes, and it will, the bailouts will make 2008 look like a practice run. The money creation will be beyond comprehension, and the inflation that follows will destroy what's left of middle-class purchasing power. The illusion of growth. Here's the philosophical gut punch. We're told the economy is growing. GDP goes up, stock markets hit records, billionaires multiply. But it's not real growth. It's monetary expansion. It's debt creation. It's the illusion of wealth generated by borrowing from the future. Real growth comes from productivity, innovation, efficiency, making more with less. But when you can create money from nothing, why bother with productivity? Why innovate when you can just lever up and buy back your stock with borrowed money? The system rewards financial engineering over actual engineering. It rewards speculation over production. It rewards extraction over creation. And you, the person who works, who produces, who creates actual value, You're the sucker at the table. Your labor is the collateral. Your taxes are the interest payments. Your future is the asset being strip mined. So where does this leave us? We're living in a system where every dollar is debt. Every debt requires interest. And the total interest can never be paid because it exceeds the money supply. A system where crises are inevitable, bailouts are guaranteed, and the people who cause the crashes get richer while you pay the bill. The 1913 system was slow, regional, containable. The 2025 system is global, digital, instantaneous. When this machine breaks, and it won't just take down one country. It'll cascade across borders in seconds. Currencies will collapse. Supply chains will freeze. The illusion of stability will evaporate overnight. And here's the tragedy. We've seen this before. The Roman Empire debased its currency to fund endless wars. Weimar Germany printed money until a wheelbarrow of cash couldn't buy bread. Every empire that tried to create wealth through monetary expansion collapsed. We're not special. We're not different. We're just better at hiding it behind technical jargon and institutional legitimacy. But you know the truth now. You've seen the receipt. You understand the machine. The question is, what do you do with that knowledge? You can't opt out of the dollar. You can't refuse to participate. But you can protect yourself. You can understand the game. You can recognize when the next crisis is being engineered and position yourself accordingly. And you can stop believing the lie that this system is inevitable, natural, or beneficial. So here's my challenge to you. Share this video. Not because I need the algorithm boost, but because the people around you are being robbed blind and they don't even know it. Drop a comment with your biggest takeaway. Hit subscribe if you want more truth that the mainstream won't touch. And ask yourself the final question. Are we wiser now, or are we just walking the same path toward collapse and better suits? The machine is running. The debt is compounding. The clock is ticking. What are you going to do about it?